Hey there, happy Wednesday. Asher here with your weekly market update, and there is no shortage of headlines. From surging market demand to crypto-backed mortgages, economic cracks, and Fed speculation. Let's break it all down. Let's start with mortgage demand. Despite rates dipping slightly last week from 6.89% down to 6.84%, we saw a huge jump in applications. According to the MBA, mortgage demand surged 11% week over week. Purchase apps rose 11% and are now 13% higher than the same week a year ago. Refinance apps also rose 11% and are up 51% year over year, thanks in large part to a 26% spike in VA loan activity. This is strong movement, especially considering how modest the rate improvement was. Meanwhile, a fascinating trend is emerging. We've talked about this a little bit in previous updates. Crypto-backed mortgages. There are fintech firms and some lenders that are now offering loans backed by Bitcoin or Ethereum as collateral. There's no need to sell, no credit check. There are up to 100% financing options. Right now it's niche. It's about an 8.6 billion market, but projections show that it can grow to 45 billion by 2030. Especially popular in Florida and California, these loans are appealing to high net worth investors and second home buyers. But the catch? Asset volatility. A dip in crypto prices could trigger margin calls, so buyers need to understand the risks. Now let's talk about home prices and inventory. For the first time in a while, new home prices are dropping, while existing home prices continue to rise. In the first quarter of this year, the median new home price fell to $416,900. This is just about $14,500 above the median for existing home sales. That's a much tighter spread than the 5-year average. New home prices are down 2.3% year over year. Existing home prices are up 3.4% despite affordability issues. Builders are responding to pressure by offering smaller homes and more incentives, while inventory still remains tight, especially for move-in ready homes. And speaking of inventory, 9 states now have more active listings than they did pre-pandemic in 2019. Those states include Arizona, Texas, Florida, and Washington. These are all key markets where inventory shifts could help ease pressures on buyers. Let's shift to the economic picture a little bit. We just got the April jobs report, and it showed a solid 177,000 jobs added, beating the 133,000 estimate. But let's take a closer look and, cracks start to show. Healthcare added the most jobs, but that's not really an economically sensitive sector. Regardless of the economy, we're still going to need nurses and doctors. Transportation, warehousing, and other cyclical industries added very little. Tariffs could further hurt trade-dependent jobs in the months ahead. The employment rate remains at 4.2%, but we're seeing signs of stress under the surface, and that leads us to today's big focus. It's Fed Day. The Fed concludes its meeting this afternoon, and while no one expects a rate cut, markets will be watching Powell's tone closely. The Fed's in a tough spot. Inflation is cooling. Headline PCE came in flat year over year, 2.3%, and the core is at 2.6%. But with tariffs looming, they're unsure of how that will impact future inflation. At the same time, recession risk is climbing, 57% according to the bond market. The Fed also has to consider labor market fragility and tight credit conditions. They've already showed their balance sheet runoff and have been quietly buying more treasuries, especially at the recent 10-year auction, which, by the way, had a very strong foreign participation, putting to rest some fears about countries like China backing away from US debt. Quick bond market check before we wrap. The MBS, the mortgage-backed securities, are flat so far today, and the 10-year is holding right around that 4.3%. Technically, we're testing the 25-day moving average, but we've got resistance ahead at the 50 and 200-day levels. The bearish engulfing pattern in the 10-year yield suggests that we could see lower yields ahead, but Powell's comments today could override the technicals if he comes off too hawkish. So here's your takeaways this week. Mortgage demand is rising fast, especially with VA and conventional loans. Crypto mortgages are real and here, but they are a riskier alternative. New home prices are finally falling. Existing prices they're still sticky. Jobs data shows strength on the surface, but some weakness underneath. And the Fed is walking a tight rope. Today's tone will be key. That's all I got for you today. Stay sharp, prep your buyers, and if you want a game plan ahead of any market movement, let's connect. I'll see you next week.